All right. Hi, everyone. For those who just logged on, my name is Dominique, and I have the rest of the Greenleaf team here with us today. And today we will be discussing our investment strategy and buying philosophy with everyone. But first and foremost, Greenleaf hosts weekly live streams and private connect events every Thursday afternoon with a new topic every week that highlights a portion of our business. Private events are more interactive, while live streams are open to the public. So to begin, I have some rules of engagement up on your screen for you. First, you do have the option to change your presentation view. Feel free to switch your attendee presentation mode to speaker spotlight view, or you can click and drag to make the presentation of our panelists bigger or smaller. We are going to do something a little bit different here today and have questions and answers after each asset segment of the presentation. And so we can categorize questions better as they come through. We kindly ask for you to include the asset class that you are acquiring about, and we will get everything answered as efficiently as possible. Lastly, this is a friendly reminder that this live stream is recorded and will be shared via email by the end of the week this week. All right, without further ado, I will pass it over to our hosts, Dave Kodre and Josh Friedenson.
All right, thanks, Dominique. We're excited to talk with everyone today and go through kind of where we're at in the different phases of Greenleaf and things that we're looking to buy. We think about where we've been. So Josh and I started in 2008. And this is kind of what it felt like right out of the gates in 2008. We really started in single families. We had about 100 single families.
Yep.
And it was pretty much just Josh and I doing everything.
Yeah,
Here's some.
Kept a whole lot of tools in the back of our car.
Yeah, we had a pretty light crew at the time of the two of us. But we did single families. We got up to about 100 single family homes that we renovated, leased, managed, operated, did all that stuff. We moved into student housing. Some of these are pictures here from Athens, where we built a bunch of single family homes. We managed developments of all single family homes.
Yep.
And we did, some of that, we were doing the unit turns. We turned like 30 homes in a weekend.
Yeah, with the students, they all move out at the same time. They all move in at the same time. You literally have like 5 on the high end, 6 days, singular days to turn.
Yeah.
At one point, I think we had about 200 homes to turn in that 5 to 6 days. So it was the two of us. We had a couple of Dave's college buddies, a couple of my college buddies would fly down, and we would roll our sleeves up and get dirty.
Yeah, so it was pretty entertaining. That was our foray into the student housing part, and then a bulk of what we did in the past was the residential segment. Those were all heavy value add apartment renovations, where we were taking kind of class F and turning it into class B, class C assets that were nice and affordable, and then we can operate all those long term.
Yeah, like this kitchen that's up on the screen. This was 608 Edgewood, and when we bought the property, Dave and I were manually ourselves pulling out the carpets. We had to be careful because there were so many drug needles in the carpets that we had to be careful when we were pulling them up. And these were the kitchens when we were done with it. We ended up leasing these things for quite a bit, and we sold this deal a couple of years ago for a pretty big home run.
That was the first deal we were able to get over $2 a square foot in rent, and in Atlanta that was a pretty big milestone. When we first started, we were around 80 cents a square foot in rent for our residential units, and we got up to that $2 mark, and now it's well past that here in the Atlanta market as a whole. But that was basically our residential segment, and that we took kind of everything we learned from that, and we applied the same kind of ideas to the different asset classes that we've gone into now. So we're going to touch a little bit about our business strategy as a whole. So when we think about our overall business strategy, we really have 3 components. We have the capital side of the business, which is banks and limited partner equity. And they're basically looking to place dollars and earn a rate of return on those and have transparency into what's happening. We have our team members, and they're joining Greenleaf, and they're bringing experience, time, energy, and resources and then our business strategies that help them advance in their career, obviously provide financial compensation to them as we perform better. And then the other kind of part of the triangle is our residents and our customers, and they are looking for a quality space to occupy, whether that's their home or whether that's a business that they have and they're renting space from us, whatever it is, they're spending a lot of their time with a Greenleaf property. So the balance of those three things is really like our customer strategy, our team member strategy, and then our investment strategy. And as we go into stuff today, the investment strategy is really focused on the capital side. It's not necessarily our people strategy, and it's not really our go-to-market, our customer strategy. When we think about business strategy as a whole, it ties all three of those together. But today we're specifically going into the investment strategy component. So when we think about the investment strategy in itself, it's like we've got three main parts.
Yeah, we basically have the physical part of the property, right? The building, the structure, the grounds, the parking lot, et cetera. And then you have the operational side, which is really the team that Dave was talking about. And, to touch a little bit more about what Dave was saying about the team and kind of the operational side is that our business has always been designed around retention. We use retention as our kind of measurement tool. Are we providing best in class service for the value that we're providing our customers? Whether that's a mobile home unit, whether it's an apartment unit, or whether that's an office complex. And so our goal is always to retain and get steadily increases as we retain and continue to provide that kind of excellent service, excellent value to the customer, so they want to stay with us and they're willing to pay more as we continue. The last piece being really the financial side of things where really, a lot of from an investor standpoint, a lot of you guys have experienced through a refinance or a sale, basically, where we create that value, you get to realize a lot of that.
Yeah, our goal is if we can do all three of these at one time, that's when we'll have the best result really in any asset that we acquire. If we're able to physically improve it, enhance the operations, and do something that enables us to move to a better cap rate, we'll have the best overall investment performance. All right, so now we're going to jump into like, what do those look like? Like, what's an example of that? So physical improvements, this is very evident on the residential side when we were taking Class F that's boarded up and renovating the whole thing. But as simple as physical improvements on an office park might be, hey, are we going to go do a bunch of TI build out and get new occupants in that space? Obviously that makes the space better, and therefore we get to realize those dollar investments. On the operational side, anything that we're doing that can drive higher rental rates while managing turnover, identifying cost savings. We've done a lot of stuff over the past with managing our utilities, from putting in low flow toilets. It's kind of one of those, like, that's relatively simple, but it still takes a lot of time. It takes dollars to go change out all the toilets and do all that plumbing work, but it lowers our utility bills, and then therefore we get to realize a higher cap rate, or not a higher cap rate, but we get to capture that value through our cap rates. And the financial part, and that's where we really see a lot of gain, is if we can get to that financial compression of cap rates. So in the medical space, an example is if we have a complex that's half medical and half other, it's like, well, that trades at one cap rate, but if we get to a fully medical deal, it trades at a much lower cap rate. So by doing operational improvements, spending money to get the right doctors in there, we can have a more valuable asset, and that touches all three of those. Absolutely. All right, so we're going to go through how we identify value and where that's really coming from. So, well located. We've kind of hit home on this one every time. If you were on our end of quarter live stream, we talked about the growth in the Southeast, and we've been sticking to that with our 2 quarters that we're operating in.
Yeah, our general philosophy is just really, if you look at Atlanta, you go north of Atlanta, 75 and 85 come together. For those of you on the call that don't know Atlanta as much, 75 and 85 are our 2 main highways here. When they leave north of Atlanta, they split. 75 goes northwest, 85 goes northeast, and we really just stay along those corridors into the major cities of the Southeast, along 85 up to Raleigh-Durham, along 75 up to Chattanooga right now, but we're also looking at Nashville and Knoxville as well that are along those highways.
Yeah, and then sub-institutional is really where we have kind of played since 2008 until now. So we're under we're under $20 million deals. We've done 2 deals that are in that $20 million range. They are kind of on the upper end of what we normally are looking at, but we are a fantastic buyer in that $5 to $15 million range where we can really execute quickly on something and it fits our team structure.
Yeah, in that price point, our competition is mostly mom and pops. And mom and pops generally do either way less frequency or way smaller size deals. So when we're coming to the table and an average year we're doing give or take 15 purchases, that's way more volume than our competition. So we have robust processes and systems that allow us to present to brokers and sellers that give us a leg up on our competition.
Yeah. And the last part here, just growing population, as you mentioned, every state in the Southeast has really, especially since 2022, a lot of that kind of COVID related, but we've had some pretty substantial population gains in every city that we operate in. So it helps, having that kind of driving your prices behind you certainly helps a lot. You don't have to be the best in the world if you have lots of people moving to your market. All right, so the first asset class that we want to cover is our medical investment strategy. So as Dominique mentioned when we're starting, we're going to answer some medical related questions at the end of this segment, and then we're going to jump into the other asset classes. But so as we go through this, if you type in any questions we have, we'll try and go through those now, and then we'll also jump back at the end of it, and we're going to answer any questions. If you think of something else, we'll certainly answer those at the end of the presentation as well. So overall, our medical strategy is to acquire assets that have both physical and lease risk to obtain value.
Yep.
You want to dive into some of those examples of what we?
Yeah. So what we like about the medical assets is that for a doctor's office to move, it's generally a much higher TI or tenant improvement build out than a standard office. So a standard office like Greenleaf's office, if we were to pick up and move, we would generally request paint the walls, do carpet, maybe move a wall or two, and we're looking at probably $15 a square foot, give or take. But when you're looking at a doctor's office and they need all these patient rooms that have individual sinks and electricity and all these extra demands that cost more money, a typical doctor's office build out is going to run closer to $100 a square foot. And that gets split up in 2 ways. Usually half to 60% of that's on the landlord, and then the remainder of that goes on the tenant. So it creates this really high barrier of entry to move a doctor's office on both the landlord and the tenant. Not all landlords are sitting around with $50, $60 a square foot for their space. And not all tenants have the ability to put their money into their space versus back into their operations. So that's a big piece of why the stability and the stickiness of the doctors.
Yeah. And a great deal for us is something that's 70 to 90% occupied, where we can go in and get hopefully the existing physicians there to expand that space. We've done that on about 4 or 5 deals already, where we purchase an asset like Parsons Medical, for example. We purchased that asset. We have one tenant that left, and we backfilled that space with other people expanding into it. And we're trying to make sure that we have 100% medical there. If we're able to buy assets that have a mix, medical and non-medical, and then we are able to convert it to fully medical, that's when we're buying something at a higher cap rate. We've converted it to medical, and now we're able to realize value at a lower cap rate because medical has lower perceived risk than kind of just general office that's out there.
Exactly.
So that's our go-to thoughts on medical. You can see this picture here is a medical deal that we just purchased.
In Clayton, North Carolina, it's a suburb of Raleigh. This is Summit Medical. It's
like 30,000
square feet. It's roughly 80% leased to medical doctors. The other 20% is fully occupied or other. And one of the value creation opportunities there is that as those other tenants roll over, we'll look at our medical tenants to see if they want to expand.
Yeah, and we have brand names are a big deal in the medical space. If we get anyone that has a hospital system name, there's lots of aggregation going on in that, but there's also big value for that tenant if they can put a North Side or they put a main hospital logo on a building. That helps us from marketability standpoint, but also helps them. They want to get their name out there and show that they have a footprint within the marketplace.
And also drafting off of these kind of bigger branded tenants will bring you other tenants. One thing we've talked about in the past is LabCorp. They're in 3 or 4 of our buildings now, and there's other tenants that like to follow LabCorp because LabCorp is a great business model that attracts customers to them, and as a result of that, other businesses will follow that, medical businesses. So yeah, it's a big part of the puzzle.
Do we have any questions on this one? No questions on medical? Okay. So we're gonna jump into kind of, this is opportunities that we see in medical. This is that's a deal that's here in Atlanta, Crescent Medical. It's an example of stuff that we're looking at, and it's 90,000 square feet, essentially.
Yeah, so the anchor here is DaVita Dialysis, which is one of the big dialysis chains in Atlanta or in the Southeast. They're or maybe the country.
They're relatively large.
And it's 100% occupied. There's not a single square foot on the property that is available. And it's all medical except for one tenant, which is the Justice Department of DeKalb County. So that would be an opportunity that maybe over time that, if the opportunity is right to turn them over and bring in another medical doctor, we can convert the thing to full medical, but it's really not a bad diversity in there to begin with. So this deal's in Atlanta Metro, and it's something that we look to bring forward to the investment community over the next 2 months.
All right, so the next asset class we're going to go into is retail, and kind of questions like, hey, what made us want to get into retail? This one doesn't have that box of physical improvements normally, but really here our goal was to generate stable cash flows and trying to find the lowest risk assets that we can get into. We've learned a bunch over the past 3 years. Andrew Ziffer on our team leads this segment, and we've really focused. We brought a lot of Dollar Generals to market. We've done Zaxby's, Applebee's, a lot of these larger brand names are where we're finding the best opportunity. And again, these aren't value gain home runs where we're buying something at 2, 3, 4x in our equity. It's more, how are we getting in and trying to get around a 10% IRR and stable, very stable cash flow without a lot of risk. COVID was interesting in how much value people place on drive-throughs. So businesses that had a drive-through did fantastic.
We were looking, if you look at a drive-through business pre and post COVID, we were looking at kind of Zaxby's is a good example. Zaxby's were trading at give or take a 6.5 to 7 cap rate pre-COVID. Then you fast forward to call it 18, 24 months into COVID now, and how the value of that drive-through now Zaxby's are trading at a 5.5 or so cap rate for similar lease terms. So that drive-through really allowed a lot of businesses to stay alive over the last.
And they excelled with that model. They're able to have a little bit lower staff, but they did pretty well. So when we look at these kind of retail brands, we're looking to be able to get something that's a national brand, so it's known, something that has operating history of around 5 years. So it's not like this is a brand new startup or something that's not known very well. We look for assets that have 80% of the average unit volume. So that means like if average store sales are, call it $1.5 million, it's like we want to make sure that we're in the upper end of that spectrum. And then along with that national brand aspect, it really helps us on the debt side because banks can easily see who these tenants are. They're underwriting as much the value of a good tenant as they are Greenleaf and our personal guarantees that go on to those types of notes.
Yeah, our lender on most of our retail deals has been a credit union. And they basically, we sat down with them a couple months ago and they said, listen, you can do as many of these you want, up to 20. We have up to $25 million available in debt for you to just keep doing these deals. And the underwriting is easy for us. It's really simple. Comparatively to these other asset classes that it takes us 60, 90 days of shopping banks. This is a very simple approach to really the full capital stack.
Yeah. And one thing we want to go through real quick, we got 3 examples here. These are all similar Dollar Generals, and to kind of identify like, how do we determine one's better than the other one? There's 17,000 Dollar Generals, there's 900 Zaxby's. A lot of these national brands, like it's not like there's 1 or 2. There's like 1,000 to 15,000 of these locations. And again, we're trying to determine how do we get the lowest risk when we look at these types of assets. So we've talked before, if you've been on some of our live streams with the Placer AI data, which is really foot traffic information. So if we keep these colors in mind, red, blue, and green. So we've tried to make them look pretty simple. And then we have a chart that can show us what is the foot traffic of each of these three locations. And in general, the Dollar Generals are trading at pretty similar cap rates. But you can see the blue one here, it doesn't even really necessarily matter like the location or where it is. It does, and we do everything. But in this example, you can see they almost have twice as much foot traffic in the blue location Dollar General as the other two. And the Placer data is able to even dive into more of like, how does that compare to the brand as a whole on all stores in the country? And you can see the blue one, which is kind of across the top, is in kind of like the top 90% of all Dollar Generals. So obviously that's a high performer. It's doing very well. The other ones aren't necessarily bad, but they're kind of middle of the road to lower end of all of the Dollar Generals. It's crazy to think how many of them are. There's over 17,000, and these are, you know, the red and the green ones are ranked 9,000 out of 17,000.
And the nice thing is, like, as you look left to right here, the furthest left, the United States, that's the whole country what Dave's talking about, is the 14,000. The middle one is really the state specific, and the furthest right is your local one. So I think that's a 15-mile radius.
That's correct.
So your blue one at the top there, it's the top performing store measuring foot traffic of the ones within a 15-mile radius, when the red and the green ones are third out of top 5 stores. So still, again, they're the red and green ones. There's nothing wrong with these stores. It's not like they're closing these stores. It's just the blue one stands out more as a top performer. And that if we can buy, if all these are equal opportunities at the same value, the same cap rate, we should be targeting the blue one over the red and green.
Yeah. All right, so that's our retail perspective. We've got a couple of these opportunities that are coming up, all based on that information. And one of these that's sneaking in here, you see this Family Dollar, and it's like, wait a minute, I thought you guys really like Dollar General. But the Family Dollar, when we look at the foot traffic, it's here in Atlanta, it's right off 285 and I-20, and the foot traffic is incredible for how many people are going into this specific Family Dollar, that it's the best one in the area by far. Which for us is like, okay, that is then, you know, piques our interest in what that looks like. So we're going to try and keep finding more of these opportunities, especially with branded operators who we can look at and know they're doing well long term. Yep. Any questions on those ones?
We do.
Oh,
Okay.
Do you look at nearby locations to determine if they could absorb traffic from a store closure, making a store a potential target for closure?
So it's kind of like, if you look at all of the stores that are out there, like, why don't they close this one, and then that traffic will just go to the other ones, right? That kind of sounds like,
that's what I heard.
yeah.
Yeah.
We don't necessarily look at, will those other stores be able to absorb the store we're buying? We're more saying, hey, if there's 10 stores in the area, we do not want to buy the 10th ranked store. So that might be the case where if they close a store, it'll go to the other locations, and hopefully we're buying those locations and not the 10th ranked store that's going to close. So if we see a local area where it's the worst store, we're not going to buy that one. So,
You know, one interesting thing on the Placer data, which we went through this when we went through the Placer topic a couple of weeks ago, was seeing where the traffic to the store was coming from and going to afterwards. And so that really helps tell, like, to your point, to the question's point about, you know, if they were to close a store, you know, where would they go, or can they merge stores kind of concept, where, you know, we're looking at kind of the radius of like, is this store pulling people from all over the state, from a 1 mile radius, from a 3 mile radius? And is there basically, is there competition in that window?
all right. All right, so next one we're going to jump into is like the government and state agency. So, and some of these are like, hey, how are these asset classes? They all seem so different. But
Oh, yeah. So yeah, we intentionally, you know, you guys paid attention to our prior pictures with the, you know, kind of the 2-story brick garden style apartments. And then the previous picture, we're not going to drive Dominique crazy by jumping back and forth here, but the previous picture of Summit, which was the 2-story medical office building. And you see this one, it's like, is another 2-story office building. So
Yeah.
to your point.
yeah, everything that we're looking at buying is in our footprint. It's typically 1- and 2-story assets that are brick that have a lot of exterior entrances and not a whole lot of common area. We kind of started shying away from common areas back in like 2011. We're like, crap, we got to maintain these common areas. It's hard to do, and it doesn't cost a lot of money, but it does cost money, and it's an operational kind of headache. So the more we can have less common area, the more we can have 1- and 2-story walk-up assets. Everything we're doing, we can maintain with the current team we have. Even our medical assets, they still have similar HVAC systems as those of apartments, whether that's a 2-ton or a 5-ton or a 15-ton system for HVAC. They're still very similar to work on and maintain. So we look at this, the government and state agency aspect. The picture we have here is a deal that we purchased almost 3 years ago now.
Yeah, it's been
3 years ago
Wow.
in Chattanooga. It was called TVTC, and we had a 1031 exchange. We rolled into this deal, and it's 50% occupied by the state of Tennessee and their finance department. So we saw that as a good bet that the state of Tennessee, they have a long-term lease. It covers all of our costs on the asset. It's just there. And the rest of it is office that we've been able to lease to the tenants that are there. So
Yeah, and one neat thing, what Dave was talking about earlier about, going to existing tenants, the main, the government tenant is on the second floor. The bottom floor is a logistics company that has been growing rapidly. And so over time, we started the property, I think when we purchased it, we had roughly 15 tenants. We're now down to, I think we're at 9 tenants now, because as people move out, the logistics company just keeps taking more and more space. So we've been allowing them, kind of giving them first right of refusal to allow them to expand. And it's actually making the deal more and more valuable as the rent will become simpler.
yeah, similar to medical, though, like if it, in the best case scenario, be like, hey, the state of Tennessee says they want to take all the space. That would be the best case in a government one, because now we've got a fully government asset. But in this situation, we have the government as kind of our downside protection, and we have the rest of it as more upside. The logistics company is paying higher rent than the state of Tennessee. Typically, that's how it's always, there's a trade-off there between rent and value in this space. But yeah, the logistics company's expanded 3 times. So they're taking over, as anyone moves out, they move in and take over that whole space. So we like this space a lot. We like having the anchored government because it gives that downside protection. And then,
Yeah, so a lot of what we like about government as well is that they have a very high renewal likelihood. I think if you were to Google like GSA renewal percentage, it's something like 97% of basically the federal government leases are renewed. This is a state one, but we also buy federal government lease buildings. As well, the governments are normally paying a little bit lower rent what the market is, so which basically drives the value of the building to be a little bit lower than the market. So we're generally able to buy these below market rate. So if the government were to pick up and leave, which happens, we're basically into a building at a lower basis than the competition, and we should be able to get higher rent than we previously had. Yes, there's gonna be some turnover, downtimes, turnover cost, but we feel like we're in a good position from a basis standpoint. And so our upcoming deals that will pop up on the next slide here, we're buying, the top 2 of these, which is the Midtown Office Park and the vocational rehab facility in Columbia. We're buying these for sub $90 a square foot. These are like $82 to $85 a square foot. You can't build these things for under $150 a square foot. So, but the rents are indicative of that. So it's a good yield, it's a good cap rate going in with a stable tenant. But worst case, they were to leave, we own this building at $80-something a square foot. We need to put in 20-25, so we're into it kind of closer to market in the 110-ish range. And then we can go get market rent, which the government's currently paying about 15. We're probably gonna get closer to 18 if we had to. So it's a good backstop.
yeah, these are all we're looking at the same kind of low rise, not urban core assets. When we went through our end of quarter as well, we talked about kind of the suburban low rise being fully back post-COVID versus the urban center high rise is still only about 50% of pre-COVID levels. So we very much like where these assets are. We like how we can operate them. We're very comfortable with the building types and structures. So that's why we like these. We really like the idea of the government backstop on the lease. So that's our government opportunities, and that's what we see there in the market. And the next one we're gonna look at is, oh, we got two
Great
questions,
question,
sorry.
Got
Okay.
excited.
If all the value is created between TI packages and leasing, why don't you sell once that's done?
Well, a good chunk of it is created if we're able to spend TI dollars and move a new tenant in. So there's definitely that value add, but one thing we're also doing is we're getting annual escalations in all of our rental agreements that we have, and especially ones if we're signing new leases, we're moving to an annual rent escalation model. So therefore, each year as we get higher revenue, and with that cap rate in place, it just multiplies the value in that. So we get paid for holding it in that sense too. The other part though is we are also trying to find yield for investors. You know, most of our investors and our kind of philosophy has always been to generate cash flow. Well, yes, we've had these big equity and capital gains, but we want assets that are able to generate cash flow. So when we get to those points, we're excited about them and holding them and earning that cash flow.
Right, and to add to that, the longer a tenant is in the building, the also more valuable it is. So the part of what we like about government buildings, they don't turn over a lot. The vocational rehab that was built for the tenant, they've been there for 25 years. So that creates a lot of value as well. So not only does, you know, the value of bringing the tenant in, the value of renewing the tenant every year, the value of getting that escalation every year, but also the tenancy of their track record of staying there and paying on time rent. So all those things just continue to add value as we hold it.
Our second question, for the government buildings and tenants, why avoid Social Security Administration?
Great. So we've looked at several Social Security Administration deals. One was in Gainesville, another one was somewhere else. But what kept coming out of it once we were doing our due diligence is the Social Security Administration is converting to a kiosk model, and you know, we've heard rumblings that they're looking at basically putting kiosks in Walmarts instead of having basically these big office space platforms that basically people have to drive for one singular purpose. So we've been there's been a lot of transition with Social Security Administration, kind of access to it, that we're a little hesitant to buy a deal and pay for that lease that we think will likely change.
All right, so the next one we're going to jump into is the industrial segment. This is one, you know, Josh and I have personally invested in a couple of these deals over the past years. So we've used that as kind of our foray into learning more about it. But we've seen a huge amount of demand for this type of stuff. The investments that we did worked out great. We invested with a different operator, not in Atlanta here, they're in Texas. We've learned a lot from that. And so as we see kind of this asset class and the demand for it, a lot of that kind of, you know, everyone wants everything right now kind of mentality, it shifts, you know, what the distribution and supply chain models look like across the country, and add in population gain and add in the fact that everyone wants to do it faster. There's a whole lot of demand right now in the Southeast for this type of space. And it's pretty specific in what people are looking for. So it's not just, hey, just go buy any kind of random looking warehouse and we'll call it industrial flex. That's not the, you know, that's not the case.
And so all these buildings are really, the definition of flex is pretty, I would say, rigid, that there's basically, like, you see this property up on the screen, the 1640 with the brick exterior. It basically has, you know, this kind of glass entry. You walk into an office, and let's just use the number, the 5,000 square foot number as kind of our standard number. So you walk in, and you have roughly 2,000 square feet of office space. You know, kind of, you know, your front desk person, couple of office rooms, a conference room, and you kind of walk straight through the building out the back door of the office, and there's another 3,000 square feet of warehouse with a roll-up door out the back for your distribution. So this is
very high ceilings.
Yeah, very high ceiling. So two things to measure here are the height of the ceilings and the height of the doors. You know, one term that's become very commonplace, whether it's called dock highs, is basically, can an 18-wheeler back its truck up to your door, or can only a box truck access your door? And that's, if an 18-wheeler can do it, is much more valuable to the tenant than if only a box truck can. Because if it's a box truck, that just means that it's a different distribution model. It's probably smaller scale distribution versus the 18-wheeler. It's gonna be large scale, and they can pay more money.
Yeah, and you know, to go out and build a new location that can accommodate all these things and has room for 18-wheelers and kind of current economic pricing, it's just very expensive.
With access to the highways in, for the most part, these are in suburban locations. We're looking, if you look at Atlanta, we looked at, basically just pulled up all
It's our
possible builds.
It's our standard footprint. If
Right.
we're going up and down 75 and 85. If you get off one of the exits, there's stuff all over the place. So you can't exactly go tear all that stuff down to go build one of, one of these type of, distribution flex kind of spaces.
Right. So the old way of doing this business was that you go out, way out where land is super cheap. An hour to 2 hours outside of the
Yeah.
city, build a giant warehouse, store it all there. And then, over time, you kind of get it to your cities with different stopping points where your packages are kind of stopping along the way. This is replacing that to the kind of just in time, the Amazon model of like overnight delivery and allowing business to get closer to the customer. So we have several opportunities coming up in this. We're really excited. Avi recently joined our team and he's spearheading our acquisitions for this. But a lot of this model is because the demand has been so great over the last 10 years, rents have tripled in this space. So what we can normally find is properties that are basically way under market rent. So right now, market rent in general is give or take $10 a square foot. If an owner has owned the property for more than 5 years, they're generally $3 to $5 behind rent. So we're able to buy these things that haven't necessarily been owned for very long that we can go in and basically upon lease renewal, offer them a higher package or turn it over. And the demand is so high, really anywhere in the Southeast, this is over 95, arguably over 98% occupied with less than 60 days of downtime on turnover. So it's a little bit of a different office model compared to our other office deals, but it's still following kind of the Greenleaf mentality of well-located deals that are in high demand areas that we can occupy and operate efficiently.
So just to recap our investment strategy as a whole here, and again, it's the best case scenario is we're able to hit on all three of these, which is the physical improvement. That could be TI, it could be exterior improvements, anything that's going to make the building work better. Operational improvements, getting better leases in place with tenants, shifting to a longer term lease, increasing rental rates that Josh just mentioned there. And then that last part, which really relies on the first two, is this financial value creation, where we have better tenants or they're paying more rent or we're more occupied, we get lower cap rates for all of that stuff. And that's where we see our capital gains. So those three aspects we're trying to do all three of those in every deal we find. So we have something, we want to be able to do all three of these to realize the best amount of value. All right, so now we're going to turn it over. We're going to bring Natalie in here and we're going to go through any Q&A and we can touch base on really any of the asset classes and help answer any questions or provide clarity to what's going through our heads sometimes when we're looking at different deals that come up.
Okay. Well, thank you, Dave, and thank you to everyone who submitted questions. We want to remind you, continue to use the Q&A feature at the bottom of your screen to submit questions as we work through those that have come in so far. First question we have for you is a retail question. Kroger announced that they are building out some ghost kitchens to help service the home delivery business of restaurant chains such as Zaxby's. How do you feel this will affect the local franchise and in turn our investment?
Some of the other ghost kitchens we've seen, especially with Zaxby's, you can brand them. They help, they're not necessarily to replace the in-place stores. They're really to help drive more business in in-place stores in more places. It's basically a marketing opportunity. So I don't know.
There a lot of this. If we look at really COVID pushing this, is these national brands, and we talk about the national brands that we like. Their like future growth path right now is exceptional, whereas mom and pop restaurants are not. So I think, as you look at like ghost kitchens, or they're going to open these locations, I think Wendy's is doing them as well, where they're going to have only kitchen locations that are all made for delivery. But also Wendy's is not trying to cannibalize the franchises that they have and other Zaxby's in that footprint. So they're trying to enable better delivery and better service to all the customers they have. So their stores should still do equally as well, just have better market penetration in general.
We were watching some of the new design concepts that Chick-fil-A is putting out. Chick-fil-A is a good example in Atlanta because Chick-fil-A normally has one drive-through lane, and since COVID, they now have 3 interchanging circles around around the
Yeah.
parking lot. And so a lot of their new designs are basically kind of the kitchen and the operations on the second floor with only drive-through lanes on the bottom floor, and say there'd be 5, 6, 7 drive-through lanes. That basically has almost like the old bank teller concept of like the suction system of like moving food up and down to get from the kitchen on the top floor down to the customer. And to kind of remove you know, a lot of the clutter of the store in the middle of the driving.
Right, yep.
Have an industrial question. Is the demand for warehousing for China imports or non-US goods, or is some also from light manufacturing?
I think this is further downstream than kind of, you know, most of that stuff coming in from China, especially in the southeast, a lot of it comes into Savannah and then it transports to the inland port that is just east of kind of Spartanburg and Greenville. And then from there, it's going to larger warehouses and eventually kind of the distribution centers that we're talking about. So we're much further downstream than kind of that, you know, inbound shipping from China.
Yeah, also a lot, the nice thing about this industrial space is like, very frequently we see tenants like churches, small kind of your contractors, so paint, drywall type of companies, and gyms, because this is kind of the lowest cost office space on the market and has the kind of the most open build out that allows them a lot of flexibility to move around.
Yeah, that's kind of like the fill tenant between, you know, the best value tenant for an industrial flex. And it's like, hey, this tenant could be here for a little bit. As we look to buy spaces that have kind of some of these fill tenants in every asset class we're in, and then eventually get to the solid tenants that we want across the board.
Now we have some location questions for you. Looking at your coverage map, is there a reason Greenleaf is not in south, east, and west of the Atlanta area?
You know.
Yeah, so we started in residential and we kind of built our operating footprint and our people and our culture and everything really going north of that area. What we've learned over that time is really the economics and really the job base is much more on the north side of Atlanta, heading kind of up the 75, 85 corridors, more so than the south side. There are some phenomenal pockets, so not disregarding at all. Like a Union, a Union City, McDonough's booming. It's crazy. But there's some substantial voids to get to those pockets that are, call it, you know, from I-20 to McDonough, you're talking a solid, you know, 20 miles south, that we've always tried to keep high density of our properties. And, you know, by skipping that kind of 20-mile gap, it's always been kind of a little bit of a barrier for us. You know, at some point, you know, we'll end up finding the right opportunity kind of in those directions.
But also ends there too.
Yeah,
Like once we get there, like we can't go further. When we go up 85, you know, when we very first started, we were on Buford Highway. We go out to like Norcross, currently out right now, and Duluth, Gainesville, Greenville, Spartanburg. It just keeps going. Gaffney, all up to Charlotte, and all the way up to Raleigh. Like there's almost an endless amount of cities along the way. So as we make progress and as we go buy stuff up that path, we're kind of always looking at stuff we have and then going and finding new stuff in that space. So it's been an easier path to growth sticking to that. If we go the other direction or go south of Atlanta, you know, eventually you get to like Macon and Warner Robins, but they haven't had positive population growth in 80 years. And so,
right.
Yeah, that's why it hasn't really fit on the growth strategy.
And then same with the same concept you apply that to Florida. We have, you know, Jacksonville's a phenomenal market, Tampa, Miami, you know, these are phenomenal markets. It's just there's a giant gap of void between here and there that we've not decided to kind of push.
There's literally a giant swamp.
Right.
So,
yeah.
You guys touched a little bit on our next question, but how and why is the Atlanta market maybe a better choice for real estate investing relative to other areas?
So, you know, main things we like about Atlanta, it's the biggest city kind of anywhere around here that people are coming to. So we have that benefit. We've got great schools that are here, and we've always had, you know, pretty solid population growth. So with those factors in mind, we're like, okay, that's why we liked Atlanta from the very get-go, was those main three things. And that's kind of held true for the time frame that we've operated, and we see Atlanta as still a very strong economic driver in the Southeast. So sticking with that, that's really why we are bullish on Atlanta, but then also all the little cities that come out of that too.
Right, and Dave and I, neither one of us from Atlanta. The Atlanta airport is just a giant driver of jobs and business and commerce in the city. And so we were very much believers. We're big fans of Delta Airlines, big fans of the Atlanta airport. So we think that will continue to be a primary driver for Atlanta as it grows into the future.
So we have some miscellaneous or general questions. What other asset classes have you considered moving into but haven't, and why?
Well, we've touched on a lot of them. So we moved out of student housing, and we probably wouldn't go back into that one. It's just the reason just challenging operationally. Student housing has performed phenomenally well over the past 10 years. We also got to the point where, like, how are students able to pay this much? And it's quite frankly a giant pain. So that's one we didn't do. The other main ones we're not in is storage. It's kind of just a completely different operating model. So it's not one that readily fits with stuff that we're doing. And same with hotels. The staffing matrix on a hotel is just completely different. You may have a hotel with 75 employees at it, which is just totally different than what we're doing. So those are three that mainly from an operational standpoint are vastly different from how we currently operate. And hotels are also normally multi-story, totally different structure. Any others? Anything we're
I think it covers most.
ports, marinas, golf courses, vineyards?
We've dabbled in some land. Land is a lot more patient of an investment without the traditional cash flow that comes with our assets. It's just a different model. That's part of the reason why we haven't done a lot of ground up development. We don't mind buying and retrofitting a building because the horizon is much shorter than buying a raw piece of dirt.
Now, would you buy property by the airport if it's a big driver?
I think the airport is a big driver of airplanes, but we haven't found anything like right around the airport that we're bullish on buying. Like when we first bought apartments, there were some deals that were traded by the airport. We're like, hey, you should buy this because the airport is paying everyone 10 grand to fix their roof per unit. It's like, well, does the deal work? It's like, we're going to get this money from the airport, but that's not a business strategy. So we've kind of shied away from stuff that's directly around the airport. There's a lot of inbound transportation and industrial stuff that's there that works great. It's just not stuff that we've found a home for in our business. And a lot of those too are not that kind of $5 to $20 million asset. Like a 1 million square foot distribution center by the airport is not $10 million. So that's also that's a much more institutional asset that we're not part of.
We didn't hear much about multifamily as a part of your strategy going forward. Is multifamily no longer attractive?
That's attractive. That a lot of our multifamily is just these big value add projects and operating them. We tried to buy one.
Right. The East Lake deal didn't work out, but a lot of multifamily right now it's really buying based on probably 3 years from now revenue. If you're projecting the trend line that has been made over the last 5 years, if you continue that for 3 years, that's the value that you have, that people are buying at right now. And whether they're right or wrong, it's really not for us to judge them. We just don't think it's really the greatest spot for our business. We think it's a little risky to bet that long ahead of a kind of an economic cycle. Or I think we all know we've been in the longest bull run, I think, in the history of time.
I don't know about the history of time. That's going to go really long, but we'll call it for a while. This has been the best part.
Since we've been really measuring bull or bear runs, but projecting that this continued bull run for another 3 years, it's just a bit much for us. We normally like to look at today's economics, and if we take the property from wherever it is right now to today's economics, and it works, and it's a winner, we'll normally buy that. But betting on 3 years from now making that work is a bit.
Like when we were talking about the industrial segment, we're saying, hey, we can buy assets and renew or replace leases and just get today's market rate and perform well. We're comfortable with that. But when we have to say, hey, we got to go get 40% higher than today somehow in the future that we have no control over really, that's when it's a little, we see that as just too risky. So.
You know, we still love multifamily, still would love to buy more, just not at 2025 values. At 2021 values would be better.
Yeah.
Our next question is a big one. I'll read through the submission and then we can answer it in parts. Are there any concerns about real estate commodity valuations, expectations for reasonable rates of return, and Fed's future monetary policy actions?
Okay, so Fed, maybe we do that question in reverse. So Fed policy and monetary actions. We just did a refinance on one of our residential assets, and we have we're doing a little live stream on that one at the end of this year too. But we're seeing great rates in the debt market, and I know the Fed has talked about, are they going to kind of slow down their quantitative easing? It's like, I don't know. I mean, they're currently buying stocks. You know, they're currently buying treasuries and kind of propping all of that stuff up to make rates as low as possible. For us, if that stuff changes, most of our debt is long-term, so we feel pretty good on that front. Josh and I think we both kind of wondering like, hey, rates have to go up at some point in the future, don't they? But we've been wrong for a very long time. So we feel like we're in a good spot for where things are right now in our business. We don't have a lot of variable rate stuff, but you got to imagine the Fed's got to ease a little bit.
Right, and for the most part, you know, when rates really plummeted last summer, we did a couple medical deals that we locked in the 5-year debt in the high 2s, right in the middle of that kind of plummet. But when the 10-year Treasury went from, I think it would drop down to as low as 60 bips, 70 bips, and it really came back to 130 bips, which is really where it is today. There was really no change in pricing at all. It really needs to have a substantial move kind of back to normalcy, which is kind of at least in the 250 basis point range, maybe even north of that, to start impacting prices. So we have some time before the 10-year Treasury gets well above 2%, pushing 3%.
So the other part of that question was commodity pricing. Is that what it was? So like so I mean, when we look at commodity pricing, and I mean everything's getting more expensive. People are like, oh, everything's getting more expensive. It's like, well, we printed a whole heck of a lot of money. So that I don't know.
They give it to everyone.
Yeah, I don't know. That's a big surprise. But for us, that makes all of our replacement costs just that much higher. So when we're buying deals, you know, and we're buying them, we can't even begin to construct or build something at that rate. We just see that as better for us in the short, that immediate kind of price rise. We can still buy assets that are well below replacement. And as long as those prices and the higher prices stay there long term, we're even better off because of that. And there's a third part of that question too.
Real estate
Fed.
commodity valuations, Fed's future monetary policy, reasonable rates for return.
Oh, yeah. Well, reasonable rates of return is, you know, yields have just been kind of pushed as low as possible. Everyone's taking more risk to get more yield. It's kind of when we look at our retail business, we're trying to take as little risk as possible to get yield. That's where we see that. But yeah, there's definitely a push to drive yield as low as possible on our values.
Since, you know, we started buying apartments heavily really in 2012, 2013, and Class C apartment value, cap rates, stabilized cap rates were give or take 8.5%, 9%. And now they're right around 3%. So if you just use that as an indication of kind of real estate asset classes, that just how much yield has been squeezed out of them, as you know, and at the same time when we started buying the 10-year Treasury, it was pushing 4.
Yeah, we just sold Ridgewood, which was a 52
unit. Yeah,
52 unit apartment. We sold it at like a 3 cap, which it's a special buyer.
yes.
So somehow that works. And that's why we're not buying the apartment stuff. We can't get 3 cap to work, but we can get 8. We can get 8 caps to work if we're finding those in the industrial segment.
Exactly.
Our next 2 questions are prospective investor related ones. First is, what is your average investment size from qualified individual investors?
So the average individual investor, so our business, to back up a second, so our business is basically made up of individual investors. We don't have any institutions really, and we don't have any family offices. We limit the largest investor to be 20% of the deal. So our business is designed for the individual investor. Our average guy is coming in at $50,000 a deal. And we're talking with them and saying, hey, you know, if you have, say, $100,000 or $200,000 you want to put with us, let's look at 3, 4, 5 deals and spread that over those deals and kind of make a little mini portfolio for yourself inside of our business. We don't have any intentions of building a diversified fund or even a non-diversified fund. We kind of look for you to say, hey, listen, here's you just saw our upcoming offerings. We have 9 deals or so coming up. You can pick up 1 retail, 1 government, 1 flex, and 1 medical office and have a nice little diversified pool of assets within Greenleaf. So that's really the way that we are looking at the business and approach our relationship with investors.
And can you share your best case, worst case scenario or experiences for investment returns across all asset classes?
Well,
It's a wide
wide
range.
net. We're in the middle
Yeah.
of one of our best cases right now with an apartment deal that we're shopping. So if it actually works out well, it'll be about a 9x. But that was a deal we bought in 2013. It was boarded up. We took the revenue from 40,000 a month to 110,000 a month. So it took us 8 years to get there. So it makes sense to create that level of value with that amount of time and that amount of value add.
Yeah, so we've done a little over 100 deals, and we've had positive returns on all of them except for about 4.
Yep.
Our downside risk that we see in kind of any asset classes, if we get if there's changes that happen in the market that really drive things to go in the wrong way. Our mobile homes, we got hit pretty hard in mobile homes with our eviction policy, not our eviction policy, but the eviction moratorium, where you couldn't evict people, especially if they owned a home. There's basically nothing. If they owned their home, there's basically no way you could convince them to pay lot rent. You would have to tow their home, and that's out of the car. That's been out of the cards for 2 years, essentially, with how long the eviction moratorium has been in place. So that created a big struggle on some of our mobile home assets, but other ones that were fully park-owned homes versus resident-owned homes, like those have been fine because they were rented and people were more apt to pay their rent than they were actual lot rent. Other issues we've had, we had one of our retail non-national brand. We had an individual restaurant, and that's our only one. And that was a giant pain. The guy kind of folded immediately during COVID. I don't know, he didn't even really try. So we had a period of evicting a business during COVID. We got them out. It was not easy, and we had a whole renovation and new tenant that went back in their place. So that was a lot of up and down and a lot of stress within that segment, especially kind of adding a new tenant and removing a new tenant in that space. So that was certainly a challenge, and we're in a good position with that now, but we lost a lot of cash flow from that whole period. We didn't have anyone paying rent for, I think, almost 12 months, a little over 12 months that no one was really in there.
Well, our general business philosophy is yield driven. So when we're buying and projecting an asset, we're much more focused on that cash on cash return number, or the cap rate number, which basically is a measurement of the yield, than so the IRR, the equity multiple. Those projections, yes, we present those, and yes, that's what the market presents, but they're so heavily driven by the exit assumptions in 5 years from now that our primary focus is, what is the shortest amount of time that we can take the asset from where it is today to producing a steady income stream for our business and for investors. And at that point, we make a decision like, okay, is now the time to sell it? Is now the time to refinance and hold it? Or is now the time to just sit here and really do nothing and enjoy it? So when you're looking at our presentations, the way that Dave and I look at them are really looking at the cap rate and the cash on cash numbers, and really that basically flow to the balance sheet and grow the cash on the balance sheet, versus the equity multiple and IRR, which is really just market level assumptions, but much more heavy assumptions than the cash on cash.
Well, those are all the questions we have. Again, we want to thank everyone for participating. And of course, we want to thank Josh and Dave for sharing their insights with us. As we wrap this up, we'll pitch it over to Dominique to review our upcoming live stream schedule.
Yes, thank you, Natalie, and thank you everybody who has attended this afternoon. We do have a our upcoming live stream coming up at 2:30 for all of our Park Hill investors. We are in the middle of scheduling out our September Greenleaf Connect schedule, but some of those upcoming deals that you all got a first look at, we are intending to have live streams for all of those, specifically Kennesaw Flex and the vocational rehabilitation department. Those details will be coming soon. Well, thank you so much for joining us today. Don't forget to check out our Greenleaf Connect YouTube channel for all of our recorded live streams, with this recording being made available by the end of the week this week. This concludes our broadcast. We certainly appreciate you joining us today, and we look forward to having you on our upcoming live streams. Thanks again and enjoy your day.
All right, thank you very much, everyone. Have a good rest of the afternoon.